When you first start investing, it all seems so overwhelming. There are so many financial products to consider, and it's difficult to know where to really begin. This is why it's very important to take a first principles approach to your investments. What is this approach? It starts with a financial goal. Why financial goals, you may ask? It's actually quite simple. Goals can give your finances direction. Hi, I'm Rishad and I'm here to simplify personal finance for you. In the year 2020, the Nifty started at around 12,000, fell to roughly 7,500 and bounced back to around 14,000 by the end of the year. No one could have predicted that a pandemic would cause such volatility in the stock market at the beginning of 2020. As investors, you have little control over the fluctuations in the financial markets. Even if you invest in smart portfolios that give good returns, the stock market does not care about your personal portfolio. And so, sometimes it might be the case that you need to access your funds well before you achieve your desired returns. As they say, the market can remain irrational much longer than you can stay solvent. So what do you have control of? It's actually quite simple. You can create a plan and work strategically to meet your financial goals. Rather than worrying about the ups and downs of the market, how about creating a strategic plan to save up for a trip to Goa, or study abroad, or even buy a car? Goals can be big, like saving for retirement, or they can be much smaller, like planning to buy a laptop in 6 months' time. Write in the comments below one financial goal that you wish to achieve. If you can, try to write 5. I'm looking for the out of ordinary stuff. Everyone has a retirement goal. But did you know there's a smart way to create a financial goal? Your goal has to be specific. The more narrowly defined your goal, the better you will know the steps to achieve it. Measurable. If your goal is measurable and has a money value, you can track your progress against it. Achievable. It is always better to make sure that you can reasonably attain your goal. If it's not achievable, it will be way out of reach. Realistic. You should have confidence that you can realistically achieve your goals with all the resources that are available to you. Time bound. Without a time value, your goal becomes open-ended and you could lose the motivation to achieve it. Once you have set a smart financial goal, what you have in hand is a money value and a time horizon. You can use these factors along with your risk and return assumptions to work backwards and calculate how much money you need to invest to meet your financial goal. What does this mean? If you want to save 200 rupees, say 10 months from now, that means you need to save 20 rupees per month for the next 10 months. That's it at a basic level. Simple, right? But on top of this, you can add your risk and return assumptions to arrive at a better conclusion. What you must keep in mind here is the attainable and realistic aspect within this. We would all love to say that we will save 100 rupees and then double that within 6 months to reach 200 rupees. But if we bet on this happening as a short-term strategy, we might be setting ourselves up for disappointment. That's it. It's quite simple when you think about it. I hope you can now create smart goals so that you are clear on your financial priorities. Want to know how you should invest to meet your goal? I have done an investing masterclass on this with the Small Case platform. Check out the link in the description to unpack this a little bit more. That's it from me today. I'm Rishad and I hope to see you in the next one.